Welcome back to another episode of Equity Mates, or should I say, hop on and pedal with us on another stage of Equity Mates, the podcast that gears you up on the race of investing. As always, I'm joined by my equity buddy, Ren, and who am I?
Bryce, you are Lance Armstrong.
Yes, correct.
My challenge here, so for people new to the show, welcome. Every episode, Bryce gets ChatGPT to translate his standard intro into a character that we then have to guess. The problem is Lance Armstrong doesn't speak like that.
Hop on and pedal with us into another stage of Equity Mates.
No, what I mean is that Lance Armstrong doesn't torture cycling analogies to make everyone know that he's a cyclist.
I know what you mean.
Yeah.
Yeah.
So
we need to finesse the input that we're giving ChatGPT to provide a result that's not quite as literal.
Yeah. You said we there, but...
Me and producer Sasha.
Okay. Yeah. As long as I don't have to do any work, great.
No, never.
All right, Bryce. Well, we have another big episode of Equity Mates. Bryce, we've got a jam-packed episode of Equity Mates today. We are going to... We've got a question from Sam from the Equity Mates community who wants us to help him convince his parents that he should invest rather than buying a house.
Yes.
A very big topic, and I'm sure a lot of parents cut all that. Not necessary. And then we're going to be hearing from your mentor, Henry Jennings, who's back from his European vacation.
Yes.
And you and him are going to sit down, touch base, and talk stocks.
Yep.
Hopefully you've done your homework.
Always, Ren.
Nice. But first, let's talk about what's in the news, what we've been doing with our portfolios. And I want to take the mic to start with because I need to offer a mea culpa.
Okay.
I got something wrong last week.
Yeah.
And producer Sasha pointed it out. We were speaking about Ozempic, the weight loss drug, and Novo Nordisk, the company that sells it. I said I hadn't been able to buy it in Europe. Producer Sasha made the point that it's also listed in the US, and you can just buy the US listed version on any broker that offers access. So she uses Stake, and she was like, what are you guys talking about? I can see it in Stake. So I was wrong. If you want to try and buy the Danish version, like I try to for some reason, you might have some trouble, but there is a US listed version.
How good. So I've bought it.
You've bought it?
Yeah. Yeah, I saw it in the notes, went into Stake and bought it. I think the reason I have done this is because...
you said it would get to 1.5 trillion easy last episode.
I'm looking
advice.
Not advice. I'm looking at this like Nvidia was in December last year.
I'm looking at this like BHP was in 1948.
And what I mean by that is Nvidia came out with an incredible market update that said, sales have gone through the roof. And then it became it became the zeitgeist, and then they did another round of revenue update, sales update, and it was another huge jump up. You can see the same thing happening here with Novo Nordisk, I think, and everyone's talking about it, but you can just see how you would imagine they're going to continue to outpace market expectation in terms of what is being sold. That's my theory.
Your thesis.
Yeah.
There's another world where market expectation has got so far ahead of reality that it doesn't.
Yeah.
Like that often happens.
Yes, it can go either way in stocks.
Have you heard of lithium this year?
Yeah, but I didn't say this is the core lithium of this time last year. Okay. This is the core lithium of 2021.
You're saying this is Nvidia rather than core lithium.
Yeah.
And I'm saying there's always a shortcoming when you just try and reason by analogy.
Yeah, well, have you bought? You're going to buy it.
Yeah. But not investment advice, but yeah. I also just have a general view on pharmaceuticals. We spoke to Ricky Bannon from IFM Investors, who's a small cap investor. She spoke about two small caps. One of them was a cancer treatment. And she was saying that a peer that's also doing a similar treatment over in the US just got bought by Eli Lilly. And you look at Ozempic, Eli Lilly and Pfizer are both now pushing into Novo Nordisk space and doing a similar drug, GLP-1 receptors. is the argument in pharmaceuticals just buy Pfizer and Eli Lilly, and whatever hits, they'll buy them?
They'll scoop it up. It could be an argument.
Yeah.
Yeah.
I mean, yeah. The challenge is, they've got such a diversified portfolio of so many different drugs and all of that stuff. What's actually driving growth? But it just feels like anything that hits, they buy.
Like alcohol. The big alcohol brands just scoop everything up.
Yeah. Anyway, late stage capitalism.
Well,
mate.
I mean, if that's the case, and if they do buy, Novo Nordisk, but
well, I think in this case they haven't needed to buy Novo Nordisk. They've just replicated the drug. Yeah. So that Eli Lilly, Pfizer, and Novo Nordisk are all in different stages of trials for the pills. Anyway, we spoke about this last week. We don't need to speak about it again.
Why not?
It just feels like it's being spoken about more than AI.
Yeah, definitely.
And I was
taking a back seat.
I was over the AI chat.
Yeah. That's my point. This is the Nvidia of December 2021.
Okay.
Yeah.
You've made that point. Well, let's move on. What else is going on?
Well, it's not really moving on because it's kind of tying it back. But you've spoken about ResMed on the show and the impact that Ozempic has had on its share price and the opportunity that created to buy like a really good quality Australian company. And you even spoke about it with Andrew Page in your mentor. And there's a number of companies, good quality Australian companies that are being hit. And I'm not saying this is a buy, hold, or sell either, but CSL is getting hammered at the moment, and hammered objectively speaking because it doesn't generally move, 10, 20% often, and it's down 22% from sort of the same period where ResMed got hit. And it's one of those stocks where, it might be overplayed. There was once a period where people were saying you just buy CSL whenever it's under $300.
Yeah.
It's currently trading at
238.
238.
So for people unfamiliar with what CSL do, biotechnology, they do a lot of blood treatments, particularly for kidney and heart disease. So make the case that a Danish weight loss drug is related to an Australian blood plasma company.
Well, they're saying that one of the side effects or use cases for Ozempic is treating kidney disease, and the efficacy of it was so successful in trial that they just stopped the trial because they're just like, it is so clear.
No way.
Yeah, it is so clear that this has positive effects of treating kidney disease, which flows back to the impact that they're going to have on this.
What can't this drug do?
I know. So that flows down to CSL, where 15% of group revenue is driven from this kidney disease business. So that's kind of where it started.
Interesting.
And the blood plasma business is also under margin compression since COVID, and so profits are under stress. So it's not just Ozempic. I think they're facing a few headwinds at the moment, but this is having flow-on effects. And so I think the argument stands where it's like, it's a good quality Australian business that has been compounding time and time and time again. Might be worth having a look under the hood a bit more. The
big three of Australian healthcare giants: CSL, ResMed, Cochlear. What, does Cochlear get hit next? All of a sudden, Ozempic stops hearing loss.
Jeez. I mean, other companies that it'd probably be worth looking at would be the pathology one, Sonic Health.
Looking at in what sense?
Well, it hasn't been impacted by this.
Oh, okay.
Ozempic thing.
I mean, maybe.
Anyway, I thought that could be worth doing the same exercise that you did on ResMed with CSL.
Okay, now can we please move on from Ozempic?
Promise. That's it.
What else is in the news?
Here's an interesting one. So a few weeks ago, Netflix sent their very last DVD, which, if you know the history of Netflix, they started with DVD delivery service and then obviously transitioned to online streaming. So I thought it was interesting that they actually were still sending them. Who's still getting DVDs sent these days?
Beach houses. Beach houses always have board games and a bucket of DVDs.
That's actually very true.
Yeah.
Okay, fair call. Well, the last one was sent. But now, have you heard of Netflix? They're going IRL in real life. Netflix House.
I haven't. Is this like the Barbie house? Is it just like a marketing?
No, they're building. It feels like what Amazon tried to do, but they're building bricks and mortar, dining, retail, and entertainment inspired shops where it's like a Netflix brick and mortar, and you go and hang out.
What?
Yeah. They've done a real. Oh, it's not a pivot, but they're trying. It's called I've got it here. Netflix recently sent its last DVD, but the stream is not ditching physical offerings. Introducing Netflix House. The biz said the venues will feature dining, retail, entertainment inspired by its top shows and movies. The first two locations are set to open in US in 2025, and global spots could follow.
Is this the start of like a Disney play?
Potentially.
Like Disney have a lot of kids stuff, like kids IP, Marvel, the Disney princesses, all of that stuff. And so then they are like theme parks is the natural extension to like engage kids in the real world. Netflix has a lot of more adult focused IP, Bridgerton, House of Cards.
Potentially.
And then it's like, how do we
Immersive
monetize
worlds.
that IP in a real world? You can go to like
a Squid Game.
a Bridgerton ball. Oh, Squid Game. That's actually a good one. Yeah.
A party venue.
Squid Game escape room.
Yeah.
Like people would have their work functions
Christmas
there. Birthdays. Like, I mean, this is all new to me, but it kind of feels like maybe that's... Oh, like a Stranger Things. Stranger Things is Netflix, right?
Yeah.
Yeah. Like a Stranger Things world where you do stuff.
It just feels like it feels unnecessary, but maybe you're right. It does mirror how Disney leverage their IP. So
yeah.
Watch this space. 2025 is
Netflix
expected.
House.
Netflix House. Yeah. It goes on to say they haven't actually said what they're going to be selling.
The thing is, Netflix have tried to monetize their IP in a few ways outside of monthly video subscriptions. I don't know if any of them have hit. Like, have you ever played a Netflix game?
No.
Well, they have a gaming division.
Yeah. I'm just reading that now. It invests in mobile games.
Yeah, and they make, like, there's a Stranger Things game and stuff like that, but it's just like, I don't know.
I'm saying it won't be any good. Calling it now.
Fair enough. I'm going to say it'll be all right. It'll be
that
like
is so soft.
It'll be like It'll be revenue,
that's
margins.
no good. That's no good.
Well, I mean, like, it's better than most businesses.
True.
Like, most businesses would love to be
True. Anyway, anything
put
from
it this
you,
way.
or should we move
It'll be
on?
more profitable than Equity Mates.
You would hope so.
Nah, look, I think that's covered it. Our analysis isn't going to get any better from here. Let's take a quick break. Let's recenter and reset, and then come back and answer Sam's question. All right, Bryce, we've taken a deep breath. We are back, and we are answering a question from Sam from the Equity Mates community. He wrote in to ask@equitymates.com, and it was such a good question. It was such an interesting question that we asked him to record a voice note.
Hi, Bryce and Ren. Long-time listener, first time writing in. Well, I'm a 24-year-old who has quite boomer parents that stereotypically love the Australian housing market. I've got a bit of money saved up after quite a few years of I've been working since I was 14, and I've dabbled in buying index ETFs, and I quite like it. My parents, however, want me to buy an investment property in Sydney, but I don't want to commit to the long-term mortgage and associated baggage, especially because I'm currently studying my PhD. And I'm not saying this is a flex. I'm just trying to say that I'm on quite a low income at the moment, and it will be for the next few years. So essentially, my question is, how do I tell my parents that I want to start properly DCAing into index funds instead of buying into the housing market? Yeah, I know that you guys can only give general information, but I'd appreciate anything. Cheers, guys. Love the show.
Love it.
Nice. Thanks, Sam. Great question.
Well, I mean, my first response is, you know what you've got to get your parents for Christmas?
Our book.
A copy each of Don't Stress, Just Invest.
Yes.
Because that is really just a
Education.
60,000 word. It's not quite 60,000 word, but it's a book length argument for index investing and why that's enough to build meaningful wealth.
I guess the challenge is they would say we built meaningful wealth through the property market.
Yeah. So I think I think for me, sorry. I think for me, there's probably two key parts of this argument. The first is expected return, and then the second is accessibility. And accessibility has a few things under it. But like expected return, let's start there. Australian housing has been great for a long time. And, you know, your parents would believe that it's going to build wealth for another generation of Australians, and maybe that's true. But the stock market has also been great. It's just been less spoken about. When you look at the Australian All Ordinaries returns back to 1900 to today, include reinvestment of dividends, it's about 13% annual return. You can build more than enough wealth getting 13% a year. A lot of housing markets haven't returned 13% a year. So I think that the first thing is, historically, in like the last 30 years, Australian housing and Australian shares have both been great performers. So from an expected return point of view, I think unless something, you know, massively changes in the housing market, you probably expect to do well on either. I think that's reasonable to say.
Yeah, that's fair. I mean, historically, that is true.
And over the long term, in the future. Yeah. For me, the reason that investing in shares makes a lot of sense for someone in your life situation, Sam, is because it's a lot more accessible and it's a lot more portable. You're 24, you're studying a PhD, you're living in Sydney now, but who knows where you will live in the future. The fastest way to lose money on property is to need to move a lot, is to incur the stamp duty and the transaction costs of buying a place in Sydney, and then once you finish your PhD, getting a job overseas or in another city and having to move and sell and then buy somewhere else or start renting somewhere else. And like the obvious answer and the dream for everyone is just buy in Sydney, get it to positively geared, build some equity, and then you can go and rent wherever you live and you can rent the place out in Sydney. But like servicing a mortgage and paying rent is difficult. Getting to positively geared is difficult. So I think for me, like the accessibility and the portability is a big one.
I think the nuance there is that if you know, Sam's parents are saying buy an investment property, so hopefully it's not something that if you move, you have to sell.
True. Didn't hear that key word.
I think for me, though, it's similar to that. It's just a pure maths game. It's more about the costs associated when you're on a low income and you know you're going to be that at uni. The costs associated with starting to build wealth in property is enormous. Like, you've got stamp duty, you've got legal fees, like all of these costs that go into it that if you just put on a piece of paper in front of your parents and say, I'm going to be 50 to 90K down the drain immediately with stamp duty, which is essentially the deposit I've saved, which I could just drip feed into stocks over the next period of while I'm at university, then it becomes a pretty compelling argument. I think also if you look at just the repayments that you would have to be paying out, the way I would do this is I would just make the case on a piece of paper with literally the maths involved.
Do the math, yeah. It's also
here.
Now I'm just thinking, like, if you had 90K, 20K goes in stamp duty, so 70K you've got for your deposit. You want to have a loan to value ratio of...
Well, you can get up to 95%, but then you've got LMI, mortgage insurance.
So what if you don't want LMI? You need 80%?
Yeah, 80. So you're looking at
if
600 grand.
Is that right?
Thereabouts.
Less than that even.
Less?
Yeah. If you've got 70 grand deposit.
Yeah, true.
But even if you said, let's say you wanted 95% deposit, 70 grand goes to a $1.4 million house, $1.3 million mortgage. There's no way you're servicing that on your income.
No
Let's
way.
say, so I had a look at servicing $1 million mortgage at 6% interest, and you're looking at about $6 grand a month in mortgage payments.
Yeah, which for a university student is just, that's...
Bro, for me, that was like...
I know.
Like me and my partner, we were like, this is going to be tough.
100%.
Yeah.
Put that in front of your parents, case closed.
Yeah.
I think also mortgage insurance is a cost, the stamp duty, the repayment, but also just like the average price of like a 600,000 loan, or like if 70,000 in deposit, the average unit price here is what, 800 grand.
I guess if it's an investment property, you wouldn't buy in Sydney.
Yeah,
So we're talking about Sydney
true,
prices
true.
here, where you pay over $1 million for a 1-bedroom apartment.
Yeah.
But if you're buying it as an investment property, you would probably look at like Southeast Queensland or Tassie, or WA is cheap, but who knows if it's going to grow.
And the argument would be someone would be paying the rent on that. Your servicing might not be as much.
Do you miss out on a number of benefits if the first place you buy is an investment property rather than an owner-occupied property?
First home buyer.
First home buyers
I'm
and
not sure.
stuff like that?
I'm not sure. I would imagine so.
Yeah.
The government wouldn't be like, oh, you can afford an investment property. I don't know. I'm speaking out of school. I don't know.
So I think, to summarize, because we've kind of jumped to a few places, I think the first argument is, you're right, your argument. The maths of it all, I don't think works.
Yeah.
Like, on a low income, having saved 90K, I don't know if you've got
You're just
the
wasting.
means.
Yeah. Not
And-
wasting money, but
Yeah.
it's huge upfront costs.
Which is really an indictment on Australia's housing market, but we are where we are. The second argument is, I think, the accessibility. Like, you can just invest what you can afford into shares. You're not faced with these massive repayments, and it just means that you have flexibility in your life. If you want to keep studying, if you want to take an academic position, you don't have to go and take the corporate job after doing the PhD because you've got this whopping big mortgage that you've got to keep servicing. So the second thing is like accessibility. And then third thing, I think, expected return. You're not going to be any worse off than shares. Some may make the argument that you'll be better off in shares than in property. It depends where you buy, all that stuff. But I think not worse off is great.
Yeah. Don't rush it. What's the rush? Finish uni.
But
Anyway.
I mean, pressure from your parents is tough.
I know, absolutely. I completely empathise with that.
And buy them a copy of our book.
Yeah, get him on the show. We'll talk to him. All right. Well,
Should we put that offer out, Sam? If you want us to speak to your parents, we will.
stocks v shares, the boomer millennial debate,
Do we do like a debate like
live streamed on Instagram.
That's not bad. But like a high school debate where like I'm first
Yeah,
speaker,
you're first
you're
speaker,
second speaker,
yeah.
and then Sam's parents are first and second
Yeah,
speaker.
definitely.
Sam's
Ding,
the
ding, ding.
adjudicator.
Yeah, 30-second bell. Oh, those. Anyway, Ren, let's keep going. If you do want to submit a question, you can send them through at ask@equitymates.com. And a reminder that we do have our Ask an Advisor episode coming up very soon, where you will put all of the questions that come through to our advisor.
Maybe we put a pin in Sam's question and also put this to a professional.
I have.
Great.
It'll be in the email coming up.
Oh, nice.
Yeah,
Okay.
so if you haven't signed up to our weekly newsletter, head to equitymates.com/email and you'll see a professional response to this question.
Yes. Yeah. And it's not just Bryce wearing a Groucho mask costume. It's actually a professional advisor.
Yes.
Every Thursday, we put one of your questions to an advisor and get them to answer it. So sign up to the Equity Mates email. But Bryce, let's take a quick break here because on the other side, you're going to speak to Henry Jennings, your mentor. He's been away in Europe and you have been keenly awaiting his return. So I'm excited to hear what you two get up to.
Mate.
Welcome back to Equity Mates. For people new to the show, welcome. At the start of the year, Bryce and I each found ourselves a mentor. We really love this idea of being lifelong learners. Every expert we speak to really embrace this and they're constantly reading, constantly listening, constantly learning because the market is constantly changing. New companies are coming. And it's just like being curious and learning is so important as an investor. So we each found a mentor to keep us honest and to keep us learning. I've been working with Andrew Page. You've been working with Henry Jennings.
Hard to know who's keeping who honest.
Interesting. We'll take that as a comment, and we'll put that to Henry later. But he's been in Europe, and he's got back, and you and him.
It's been a big break actually because I went to Europe, then he went pretty much the day I got back. So we had a lot to catch up on.
Great.
About our Europe trip.
Well, we'll see how much of that makes it into the final cut. But here's Bryce and Henry.
Let's get stuck in. So, Henry, we've both been over in Europe,
We have.
which has been very relaxing.
It is.
Did you tune out of the markets when you were away?
I did actually, Bryce, and just decided to sort of disengage and try and get a fresh head space come October.
Yeah. So the ASX and the S&P sort of tracked each other somewhat. Now, when I went away, there was somewhat of a feeling of a little bit of optimism. It now feels like the market has reversed somewhat. This is at least how I'm seeing it.
Yeah.
And people are getting a little bit nervous again. We saw inflation pop up somewhat. The commentary coming from the Fed is that maybe rates will be higher for longer. How are you seeing the market now that we're back in action?
Well, I guess September seasonally can be quite a weak month. There's a lot of fund managers that come back from Long Island and Nantucket and all these places in America, Martha's Vineyard, and they're cranky. They've had the juniors look after the market in the summer time in the Northern Hemisphere, and they get back and they're cranky. And September can be a bit of a downer as a month. October, traditionally, is actually one of the best months of the year, despite the fact that we've seen one or two perilous crashes in October. But September certainly wasn't good. A lot of companies going ex-dividend as well on the ASX, so that does take points off the index. Some of that money now is coming back into the market because the checks have dropped into the accounts, or the bank accounts are stuffed full of money again. So we are seeing things pick up a little bit. The interesting thing, I guess, is the narrative around what the Fed's doing, and you were talking about that. The higher for longer, that certainly seems to be pervasive now, in that they are going to keep rates higher for longer. But the narrative has changed, I guess, in the last week or so, from just higher for longer for no more rate rises, but maybe no more rate cuts, and the soft landing that we were talking about and thinking about in the past, maybe that's happening as we speak. I mean, we've still got very, very good jobs numbers coming out of the US. That non-farm payrolls was huge that we saw last week. We're still seeing good economic growth. We're seeing relatively good economic growth here, low jobs unemployment as well here. So we're kind of muddling through at the moment, and the market has been very oversold. So we are seeing some buying creep back into October, and especially as there's a lot of cash on the sidelines from all these dividends, and in the US a lot of selling has meant that there is this cash build-up. So I'm slightly more optimistic. There are a lot of things happening as well on the macro front, which, with oil and gold, and of course what's happening in Ukraine, and now what's happening with Israel and Hamas. So it complicates things, but markets do tend to try and look through these sorts of things unless there are direct implications. We saw a spike up in the oil price, which is kind of, oil trading 101, gold spiked up, gold trading 101, but it hasn't really kicked or followed through yet, so we'll wait and see how that pans.
What I'm trying to sort of get my head around at the moment is we've had 13 interest rate rises over the last sort of 12 months.
Yep.
We'll call it, a little bit before. And we're having this mortgage cliff. We're kind of halfway through rolling that at the moment. We've had bond traders in here, or
Yep.
bond fund managers.
Yep.
We're on, distribution lists that show us what you can buy and if you've got the money to do it, and
Yep.
you can get returns or yields of 12, 13% in some instances, which is all well and good for those that can afford it. Firstly, do you buy bonds does it become more attractive for you now, or is it just not part of it? How do you approach it?
It's not part of my thinking, to be honest.
Yeah.
It's not easy for small guys to buy
it's
bonds.
impossible.
It's impossible.
Yeah.
Yeah, it is not easy.
Yeah.
Obviously you can just leave the money in cash management or something like that, and you're getting relatively good rates now. But as far as, the thing about the bond market is, it's for big boys. It really is for big boys. And in times of yore, the bond movements were very small. You didn't have these massive 14 basis point changes in 10-year yields overnight, every night. You didn't have that. It was very small little marginal increases or decreases. So because they were small, you had to throw a lot of money at it, and it attracts the big players, and it's all the big money in the world. The US has got to fund, $31 trillion of debt, all the stuff they've got to issue. So it's a big boys game, and there are a couple of bond ETFs that you can trade, which is probably the simplest way for retail people to to trade it. And there are a couple of, there are guys out there that do specialise in the retail end for bonds. But it's, from our perspective at Marcus today, we look at obviously the risk-free rate because everything is therefore priced off the back of that. But that's probably as far as it goes for us. We are equities people.
I want to go there because we're getting now 4.5 plus in bank accounts, 5.5 for some of the good savings accounts. And you're right, I can't remember a time in my life that it has been that good.
No.
Maybe early days like school, but like I'm thinking through uni and stuff. Even when I was at the bank, you had to go like long-term deposits and those sorts of things. But at call savings accounts, I can get 5.5%.
Yeah.
And so it's sort of changes the way you think about what you do with that powder on the side.
Yeah.
So how has it changed what you're looking at or buying over the last sort of 12 months?
Well, I guess, a lot of the speculative end of the market, I'm not talking about the good tech stocks, the US kind of tech stocks, which have been on a different basis, the AI boom, etc. But certainly from a perspective of our minuscule tech sector and our small caps in biotechs or whatever, having money in dead stocks that aren't doing anything, that you're waiting for 6 months for them to do something, that is costing you money. In the past, a year or two ago, when you were getting zero on your deposit rates, it wasn't costing you anything. You could sit there because you've got no alternative. We had Tina as opposed to Tara. Now there are reasonable alternatives. And as a result, you've got to time things a little better because the price of money, the cost of money, you're competing all the time. And we have seen small caps sell off considerably. All that speculative money, the hot money that was in the lithium space, a lot of that has been well and truly shaken out, which I think is a good thing. It will make people a lot more disciplined, I think. And it means that you've got to think about where you're allocating your capital to because you do have an alternative. And that is just sitting there with cash.
So does that mean you're wanting to allocate into stocks that are either paying a yield or that aren't what you just sort of said are going to sit there and be dead? Like, are you looking for much more sort of short-term catalyst that's going to give you a more immediate return?
I think we've seen a lot more momentum trading, not just in equities, but also in other markets. And people have been jumping on board things and just being part of that momentum because you don't want to be in the dead money because you can get that return elsewhere. So you want to get on the stuff that's moving fast, and maybe you need to be more active in what you do. I think that's certainly something, a bit more disciplined with your capital allocation. I think, the good companies are still doing relatively well, and the ones that are high yielding and have fully franked dividends, of course, which you don't get on the deposit accounts, are still in demand. We've seen that with the banks. I have a big bank basket, which I call it, which many years ago you could buy all 4 local banks for $100. So I've been tracking that forever for the last 10, 11 years when you could buy that. And it's now about $176.
Okay.
And it topped out at about $215, and it bottomed at 107. That doesn't include any dividends. That's just the 4 share prices added up. But that has stayed pretty stable for the last little while. And certainly, investors just keep buying the banks. It's such a bedrock. Fully franked dividends. The appeal of BHP and Rio has waned slightly in terms of dividends and Fortescue because of they were quite generous at times recently, but they have been less generous as commodity prices have come off. But I think, the high-yielding stocks have done okay. They've held up, whereas others, we've seen WiseTech having issues. CSL, which was a market darling, that myth has been well and truly busted at the moment. The same with ResMed. So a lot of things have come back into more normal kind of pricing. But I'd say the next 12 months we're going to see more muddling.
I was just thinking about that. Like, what's the ASX up at the moment? 200 year to date is about 1.9%.
Yeah, it'll be.
So it's flat. Call it.
So chuck in dividends of 4.5%. You got to.
So it's probably matching a high interest savings account.
Yeah, which
return.
doesn't make it
Which
doesn't make it that attractive.
Exactly,
But we've
yeah.
seen you're young and you haven't seen this, but when I started in the markets back in the early 90s, or the early 80s actually, interest rates went to 17% in the UK. And all the time they were kind of 3, 4, 5. Even when John Howard came in, they were looking at raising rates to 7% at one stage, and everyone was screaming blue murder. So it's not unknown. Long term, these are not abnormal interest rates. What is abnormal is the speed that central banks have moved. It has been unprecedented. It's a great word, isn't it? Unprecedented. But it has been unprecedented in the speed they have moved. And it has taken people by surprise, and it needs people to adjust and work out, okay, there are alternatives now to shares. Maybe the bond market is the good place to be. Maybe we should look at hybrids. Maybe we should look at just cash in the deposit account. There are alternatives.
So we had a listener question come through that I think would be relevant to this, and it was pretty much, they understood the value of dollar cost averaging at assuming they're our age and just getting it into the market.
Yep.
But now they're faced with the opportunity of putting that money into 5.5% interest rate. What would your, I guess, just advice be to someone or everyone sitting there listening now to there's an opportunity cost and also pursuing a strategy of long-term money in the market?
I think it's going to still be hard to beat long-term money in the market.
Okay.
I think even if we saw interest rates spike from here, which I don't think we're going to see, I think we're kind of close to peak. There may be one more, but crikey, that's pretty close to the peak. I think, at some stage we are going to have issues again, and central banks are going to have to tickle the market a little bit, tickle the economy. So I think at the end of the day, equities will still win out, or even housing to some extent, but equities is really what we're talking about. And dollar cost averaging over the long term has been a proven winner. Just leaving your money in the bank at 4.5%, that's fine. You're not getting any tax breaks out of that. So, if you're paying the higher rate of tax, you're still going to be, it's still 2.5%. So you're not going to get too rich on 2.5%. You're going to wash your face, and by the time the bank takes its fees and charges your dead uncle, etc., for those fees and charges, then you're not really going to be going forward. Whereas you will be going forward ultimately in the stock market. And especially if you're buying ETFs, say, that have got good yields, or stocks that have got good yields, you won't really. We did some work on how retirees and older people don't care about share prices. They really have no interest in the share price. All they care about is their dividend check. The share price is only of a consideration to their kids who will get the shares when they die. And they'll go, oh, I need the income now. So they'll keep them forever. I mean, CSL, people are still from CSL from when it listed, or CBA. They don't care whether it goes up $1, down $1 on a daily basis. They just want their dividend check.
Fully franked.
That's all they want. And I still think equities will be the place to be, but you just got to be more disciplined, because there are now alternatives, at least in the short term. It may not be the long term, but in the short term, there are alternatives.
And then to close, and maybe to leave us with something to think about before we connect next, it's where are you looking at the moment to buy? And I guess, have you bought anything post-Europe? What's your plan of attack over the next couple of months?
I've been looking at some of the really bombed out sectors. Lithium for one. I still find it confusing. Again, that's a good word that we've been using a lot. Confusing that Gina's bought nearly 19% of Liontown. And
so how are you using what's going on there to invest in around it?
Well, I guess we've got everything in the market is a relative basis, whether it's the risk-free rate or whether it's a corporate transaction that is a sort of a liquidity event. Liontown is a liquidity event for the Liontown shareholders, obviously, but it also puts a line in the sand as to what an industry player like Albemarle values a company at. It's valuing Liontown at nearly $7 billion. Which is a lot of money for a company that hasn't produced anything and is still building the project. So then you look at various other companies at various different stages, and then you can derive a little bit more value. It's like something like Pilbara, which has had a massive tanking, and as I say, 12% of the stock is shorted. That's capped at about 13, 14 billion, but it's got 3 billion in cash. And it produces, and it's got downstream assets, and it's got expansion plans, etc. So you look at that and you go, well, that looks relatively, compared to Liontown, that looks pretty good value at these kind of prices. And then I guess you can look at other lithium companies and in the same space, because you want to compare apples with apples. And you can say, well, okay, this one's got this big resource, it's this far down the timeline. We know that Liontown sold for 7 billion, therefore this one is worth 1 billion or 2 billion,
depending where it's at
depending on where it's at in their timeline. So you can kind of look from there, and the same applies in any industry when you get a big takeover target. And we're losing them. We're losing ASX stocks. Origin. Again, you can look at Origin and go, okay, well, if Brookfield pay whatever they're going to pay, because we don't really know what they're going to pay. If they pay $9.15 or whatever, that gives the value of 18, 19 billion, and then we can look at APA or another kind of company. And if same with Virgin, if Virgin floats, is Qantas cheap on the back of Virgin? True. So you're trying to compare apples with apples and relative things. So at the moment, I'm looking at stocks that have been whacked disproportionately to their business product, and some of those are in the tech space, some in the lithium space, base metal stocks as well. And to some extent, gold stocks, that they have recovered recently because of the uptick in the bullion price and what's happening around the world. But in Aussie dollar terms, that gold price has held up pretty well. And some of these Aussie, like Newcrest for me, looks kind of interesting because the merger with Newmont is about to be consummated. We're in the final countdown there. What does this big behemoth now look like? And who is going to be interested in this from an investment point of view? Newcrest has gone down to sideways during this whole process because there's always uncertainty and moving parts, etc. But when you put one and one together, do you get 2.5? I suspect you might, and you might see big funds go, okay, well, this is now such a big gold company and other metal company that you can't ignore it, and you'll get Newcrest, Newmont, the combined entity re-rate higher. So there are stocks out there that you look at and you think, CSL.
Did you ever look at ResMed?
Yeah, we've talked about ResMed in the past.
Yeah.
I hated it for a long time and was very vocal about it. And then when it dropped after the results, I started to get interested in it a little early. And there's all this chat about how weight loss drugs are going to change the world, no one's ever going to get sleep apnea again because everyone's going to be slim, trim, and look like Kendall. That is not going to happen. That is not going to happen. We saw it last night. PepsiCo, their results came out. They said, "Nah, you know what? Haven't seen it. Haven't seen that. It's not cheap. It's not cheap. If you wanted to do that in Australia, it's $300 a month.
Whoa!
And it's every month.
Yeah.
It's not just 2 months and we're done.
And it's not. Yeah, exactly. Yeah. You either keep going,
for
life.
You're
likely to put it back
for life. And we're now starting to see reports of some of the side effects, which can be interesting. Nausea, diarrhea, constipation. Not sure how that works, but so it's not the. So I think ResMed. The problem they've got is once you've bought a machine, that's it, and the machines cost the same. They're $1,500, $1,600. It's not a SaaS model. There's nothing else.
More customers.
And they've got to get more customers. And the problem is that a lot of the existing guys, they quit because they don't want to look like, Maverick.
Yeah.
Because it's not very romantic. So a lot of people quit quite early and they don't go back to it because it's just too hard.
Yeah.
Others continue, but there's no ongoing. And I think that's where they failed to really capture the ongoingness, to turn it into some sort of SaaS model.
More recurring.
Yeah.
Anyway. And then finally, LRS, Latin Resources. We spoke about it before we went away. Still holding? Still holding.
I did sell some the other day at 29 cents. I'm having bought some at 23.5 on a bit of a sell down. Still holding, still like the story. Obviously, it's following a playbook. Sigma Lithium is the playbook next door, not immediately next door, but they're very close to them, both geographically and also corporately, if that's a word. But they are very close. They got quite big ties between the two companies. So I still like that one. I saw some research. There's been some guys doing some work on it, 45, 50 cents. They're popping back up to 30. They're a buy below 25. They're a sell at 40 as far as I'm concerned. And here at 30, they're kind of sloshing around a bit.
Nice.
But we are seeing a little bit of interest in lithium stocks again. And some of it's short squeeze, I'm sure. Some of it is just, brokers have started to go, we may have whacked our lithium forecast a little too much. Because at the end of the day, if lithium prices went down another 50%, there's going to be no one out there doing it.
Yeah.
You kill the supply.
It's not going to happen, though. No, can't.
It's possible, and there may come a time when we just look upon lithium as just another chemical, which is what it is, rather than a mining. It's a chemical process as opposed to a mining process to some extent, especially with the brine. But there's no doubt that we're all friends electric. You only got to drive around Europe.
Yeah, I know.
Especially in London.
Yeah,
God,
yeah.
London's got these new ultra-low emission zones.
Oh, wow.
Oh, yeah. They're a beauty. Some people, when they drive out their driveway in the morning, cost them $12.50 because they've just been named as an ultra-low emission zone.
Whoa.
And because their car is old,
you get slugged for it.
It doesn't qualify, so you have to pay £12.50 a day. Sorry, £12.50 a day. $25
to drive around.
To drive around in your own area. My brother can't drive his car from where he lives to the local shopping centre because that's just in an ultra low emission zone, and it will cost him £12.50 to do so. So it's funny because in the UK, some of the old car now are getting very cheap if you're in one of those zones because you can't sell them to anybody who lives in those zones. So you can pick up some real bargains because people have got no choice but to get out of their car. And it's not just London, it's starting to spread now to other areas of the UK, and it's also starting to take hold. It used to just be the congestion charge, but now it's kind of everywhere. And I had a couple of hybrids while I was in Europe to drive, and they are, you go to the petrol station and you fill up and you go, that's quite good.
Yeah, I can see what they're talking about.
I can see what that's because petrol is expensive. So you can see it's that the oil price is only going to hasten the EV thing. And the choice of models is getting. It's not just you can have a Tesla. What colour do you want? Now there's a big range. The Chinese are flooding Europe. They're flooding the market. We're seeing it here. EVs are under 45 grand now. Teslas are comparative to ICE vehicles. They've dropped the prices so much, so it ain't changing. This is, unless someone invents or pushes the sodium battery, lithium is in the middle of the Venn diagram, and it still is.
Well, there you go, Ren. It was great to catch up with Henry. Hopefully we're going to get both our mentors back in a couple of times before we close out the year, and maybe do one final wrap with them. We'll see. But it's been an enjoyable journey so far. And that brings us to the end of today's episode. Or do you want to do the rest of it?
Yeah.
It's been an enjoyable journey so far. Interesting to get
or just come straight out of it and then do the ResMed thing and then do that whole spiel.
Okay. Well, it's great to chat with Henry back in the studio. Interesting to hear his thoughts on ResMed. Not as bullish as perhaps you are particularly. But anyway, each to their own.
Oh, okay. I thought you were going to ask me.
Well, what do you want me to say?
Just.
What are your thoughts?
Yeah.
But I mean, you haven't heard it.
Doesn't matter. I've got something. Just.
Okay. Well, it was great to catch up with Henry. Ren, thoughts on his view on ResMed?
Yeah, different to mine.
Yes.
But as the great American publisher William Feather once said,
here we go.
Every time one person buys, another sells, and both think they are astute.
Well said.
So time will tell.
Well said, Henry. Who was it?
William Feather.
Time will tell. But look, we're going to try and get both Andrew and Henry on the show a couple more times before the end of the year to close out our 2023 with them. Plenty has been going on. before we get into final bold predictions and close out the year. So it's going to be honest before we know it, but we'll close it there. If you want to ask us a question, a reminder, ask@equitymates.com and sign up to our weekly email, equitymates.com/email. But let's leave it there. We'll pick it up on Thursday.
Sounds good. Hey, one thought, not about